Okay, in this video we're going to talk about the factors which impact yield spreads. Now remember that in the case of corporate bonds which are deemed to be risky, those corporate bonds will typically, because of their risky nature or credit risky nature, will trade at a premium, at a yield premium, that is, at a yield premium or a spread relative to default risk-free bonds. In other words, let's get this cleared up. If you take a default risk-free bond, which is typically a government bond, the investors will not require so much yield from it as they would from a more risky, i.e. corporate bond. And that means one of two things. Either the price of that riskier corporate bond is going to be lower relative to the government bond, or it's going to have to offer a higher coupon to trade at the same price as the government bond. In both cases, we can quantify that as a yield, which is going to be expressed in basis points typically. So trading at a premium, when we say yield premium, may actually mean trading at a lower price. And how much that premium is, how much that yield premium or so-called spread is going to be, the yield spread, this depends on, well, your curriculum says it depends on three groups of major factors: macroeconomic, market, and finally issuer-specific factors. What we will do right now is examine all three groups one by one, starting with macroeconomic. Macroeconomic factors as they pertain to the yield, right? The extra bit of yield, so the yield spread, the yield premium, the extra bit of yield that we add to what would otherwise be the yield for default risk-free bonds. This is going to be very much a discussion of how the economic cycle impacts the credit cycle, something we'll be covering a lot more in the economics section of the curriculum. So, as business conditions in the economy improve, as they get better, of course, spreads narrow. So they become smaller, meaning we don't add as much of an extra yield premium to what would otherwise be demanded or required of government bonds or default risk-free bonds. And those spreads are narrowest, at their narrowest, at the peak of the cycle. Okay. On the other hand, this is so obvious. If business conditions deteriorate, then you will see spreads widen. And again, when are they the widest? Well, they're the widest at the bottom of the cycle, or close to the bottom of the cycle. Bottom of the cycle. Good. Now, your curriculum does then go on to discuss some factors which are specific to high yield bonds and investing in them. So it starts with the rationale for investing in high yield bonds. It's not necessarily the best place to discuss this specific section of the curriculum, but it does. So let's mention it here. High yield bonds, will be often abbreviating this to just HY. First of all, they give you portfolio diversification. Why? Because a lot of the time, high yield bonds have less than perfect or lower levels of correlation with the investment grade bonds, IG bonds, and also government bonds. Government bonds being, your default risk-free bonds. High grade, so investment grade corporate bonds and government bonds often go in tandem, whereas high yield bonds can have less than perfect often have less than perfect correlation. So they that, by virtue of the equations we've got in portfolio theory, in portfolio management, provide room for diversification. The second point is capital appreciation. So still on the rationale, the reasons why you would want to invest in higher yield or high yield bonds, being of a lower credit quality, of course, these types of bonds are often more sensitive, and of course, once again, more sensitive than your investment grade bonds, the higher rated bonds, to economic conditions. So when you've got economic recovery, for example, those bonds will will shoot up more. They'll also probably fall more if there is something wrong happening in the market, in the macroeconomic environment. But if you can buy them at the right time, they should provide you more of a boost, more of a lift, a bigger yield, plus issuer-specific news often. They'll be more responsive to news about, better than expected results, an announced restructuring, an announced management change, an announced merger and acquisition, that kind of thing. Okay, and let's have one more reason here coming from the curriculum. That's going to be equity-like returns. Equity-like returns, but with lower volatility. And high yield bonds and shares, basically common shares, equity instruments, they both fluctuate up and down over the business cycle. Providing similar levels of exposure. But still, high yield bonds, when you compare them to equity, are going to be more stable because you are assured, or you are told, that there should be a certain level of income you'll receive, and if not, you've got a claim on the company's assets, etc. And that claim is net assets. The claim is definitely assets. The claim is definitely higher than that of equity holders, but high yield bonds are nevertheless, or should be, more stable, okay, than equity. So something to consider there. And also, coming back to the idea of yield, some additional considerations here of a macro. Well, it's not of a macroeconomic nature. Now, in this section, your book is a little bit, sort of, I think, inconsistent when it comes to placing certain ideas or mentioning certain concepts. So let's just, mention them as they appear in the text. If a bond has a higher rating, okay, then obviously, because of the lower risk involved for any given maturity, it should have a lower yield, and therefore a lower yield spread. Obviously, comparing bonds with the same maturities. If a bond has a longer maturity, then you would expect it to have a higher yield associated with it. Because in the long run, it's more difficult to predict what will happen to a company, whether it may not get into, trouble. So there is higher default risk for longer term bonds, and that's reflected in a higher yield spread. And when it comes to investment grade ratings or rated issuers, there is definitely a smaller difference between yields. So generally, investment grade issuers share similar levels of risk and therefore have relatively similar yields associated with their bonds, which is a function of having similar levels of yield spreads or premia. However, there's going to be a much bigger difference when you compare IG ratings versus high yield ratings or high yield rated issuers. Here, definitely the jump between yields associated with an IG issuer, investment grade, and a high yield issuer is going to be much bigger than across the different grades belonging to the IG investment grade universe. So bigger difference, or a bigger jump in yields, especially as you cross that threshold, and then as you move each notch downwards, the yields tend to balloon up and up as you get closer to that, the lowest ratings like C or D. Okay, let's also mention that especially under adverse market conditions, so when things go wrong, and this is absolutely to do with macroeconomic factors now, high yield bond spreads tend to widen quite a lot. High yield bond spreads, well, yield spreads widen, and you can think of it in the following way. If you've got a high yield bond, in times of market stress, you're going to, require more from it. However, as compared to your typical government bond, which is associated with having no default risk, essentially. So this is going to be our default risk-free bond, or yields on such bonds, because there is this mechanism of investors selling risky stuff and moving towards safer forms of investing. They will definitely try to get some default risk-free bonds, i.e. government bonds. So as a result of this, investors are selling the riskier assets. That's driving the prices of these riskier assets like high yield bonds down and yields up. And at the same time, they are buying the safe stuff, like American government bonds, for example, which always pick up in price when there is something bad happening in the markets. Default risk-free bonds, that demand, that buying tends to lower yields on these default risk-free instruments. This mechanism is called the flight either to safety or the flight to quality. But as a result of selling one instrument and driving its yield up, buying another instrument and driving its yield down due to prices going up, you get a widening of the spread. That's what we mean by spreads widen over here, and you kind of need to appreciate this mechanism. Please appreciate that there's always the risk of liquidity or liquidity risk. In times of stress, the bid-ask spread widens, so it becomes more difficult to buy instruments or sell them at a price close to what should be its sort of intrinsic value, but we'll talk about that in just a moment under market factors, at least the idea of market spreads. Oh, sorry, bid-ask spreads. Let's just mention a few other reasons for yield spread changes. So we've just mentioned things like, that the yield is definitely related to economic conditions, the rating of the bond, what maturity it's got, whether it's IG or high yield. And in the case especially of high yield, you have to appreciate that in times of market spreads, yields will run away, they will widen. What about other factors? Well, tighter financial regulation is mentioned in the curriculum. Tighter financial regulation, especially when banks get regulated tighter, the screw gets turned. This will increase the cost of capital for banks. Higher cost of capital. And remember, banks need to hold capital in order to support their activities. If you want to be a market maker, a dealer who buys, sells bonds, you have to have capital, you have to have funding, you have to have capital to support that activity against, or to absorb potential losses from it. And as capital becomes more scarce, or the cost of capital becomes higher, that will definitely impact your ability to do dealing, buying and selling of securities. So this will also impact spreads potentially. Sometimes banks also get into trouble and there is a funding stress, so they literally don't have the liquidity to support their buying and selling and hold an inventory of securities. Once again, this will impact spreads. General market sentiment, whether investors' sentiment are indeed willing or unwilling to take on risk. If they're unwilling especially in times of market stress, that will that will definitely make yields higher. And one point which I find actually very, very logical, very nice, is if there is a heavy, strong supply of bonds coming to the market, so many new issues coming to the market, then, as with supply increasing in every area of economics, if there's too much supply relative to demand, that will drive prices down, which in the case of bonds means yields will widen, or spreads widen. And it's the opposite. If there is strong demand but not much supply, spreads narrow. However, so if supply is scarce but demand proves to be high, which is the very opposite scenario, then you're going to have spreads narrowing. Hopefully nice and logical, quite straightforward, I hope, right, for everybody. Now, those were the macroeconomic factors, although some of them may just as well be called something else, like market factors, to be honest, because that's the next category, market factors. And it's very difficult sometimes to separate one from the other because they are so intertwined, linked. Okay. However, in your book, this discussion is focused more on the idea of what a yield is actually made up of. Apologies. So let's start with a sovereign issuer. If you are a government, or if you're investing in government bonds, then your bonds are going to be deemed to be default risk-free, and the yield on such default risk-free bonds, default risk-free bonds will essentially be made up of the real interest rate, or interest rates depending on maturity. So how much investors want to earn, aside from the impact of inflation, and on top of that we add an inflation premium, and that essentially would be your inflation adjusted default risk-free yield. However, when investors decide to get into corporate bonds, because of the additional risk involved, the credit risk, they also require a credit risk premium to compensate them for the effect that these bonds may not be paid in full and in time, or the money may not come in full and in time. And there's also an element of liquidity risk premium, which we will be focusing on right now. Plus, with some bonds, there may be, a premium for potential tax effects if those bonds are treated for tax purposes differently than sovereign default risk-free bonds would be. And all of these additional premia which we expect a bond to generate for us, this is captured, a corporate bond to generate for us is captured by the yield spread, because we're talking about the yield spread over and above the government benchmark. So over here is your government bond yield, and here is the extra bit that we add on top. So this is over the government benchmark. And we will now specifically, because this is what your book does, focus on this liquidity risk premium element here, talk about it. It's basically a reflection of the risk, so reflects the risk that the price at which an investor can transact, either buying or selling, may differ from the price they see in the market. As indicated typically in the bond market via the bid-ask spread. And this is going to be especially, a problem for big buyers and sellers, hence liquidity risk, because you may go and see what dealers are offering in terms of the price at which they are willing to buy and the price at which they are willing to sell. But what if they're only willing to buy relatively small quantities at these prices, and if you try to sell a bigger number of bonds or buy a bigger number of bonds from them, it turns out that liquidity is an issue, and they will be willing to do so, but at prices which are much less favorable for you, the investor. So if you're trying to sell to them, they'll pay you a much lower price if the volume is big. However, if you want to buy from them, they'll once again offer you a higher price, or ask you to pay a higher price, because they simply don't have access to this stuff, so they need to find it somewhere, etc., etc. So liquidity risk is an issue. However, there are some factors that we need to appreciate that impact liquidity risk and determine how big an issue it really is. So factors influencing liquidity risk. And these are, very valuable to remember, because I can see how perfectly these could be made into a potentially a theoretical question. So, the first one is going to be issuer size. And probably even more important, the aggregate, the total value of that issuer's public debt. And the other one is issuer quality, as in credit quality, as typically reflected by their specific rating, their credit rating. So when it comes to size, or even more importantly, aggregate value of the issuer's public debt, this is a simple one. The less debt you've got outstanding, the less frequently it trades. So more liquidity risk. Less debt outstanding means less frequent trading. And the tougher it will be for an investor to either buy a large quantity of your bonds or sell them if they want to sell them, right? Which is what investors worry about. Ooh, if it comes time, if time comes that I want to sell these bonds, will I be able to get a relatively good price? Well, not if the market's not liquid and not able to absorb these bonds. You'll have to sell them with a pretty big discount. So less frequent trading, higher therefore levels of liquidity risk, and as a result, a wider bid-ask spread, essentially, as you will see if you ask a dealer for an offer. Now, in the case of credit quality here, well, the lower the credit quality, generally, the higher the liquidity risk. Investors don't trade as much in the in the more risky instruments, in the high yield instruments, as they do in the default risk-free or simply the investment grade corporate bonds. There are much more instruments there than they are in the high yield market, and there is a big link to issuer quality in terms of how much trading gets done. The critical measure here is going to be the bid-ask spread, the difference between the price at which dealers are willing to buy bonds from you and the price at which they're willing to sell to you. The less liquidity risk there is, or the more active the market is, the lower that difference is going to be. It's going to be very narrow for sovereign bonds, for example, but a lot wider for corporate bonds, especially high-yield corporate bonds. And let's also kind of mention, I did sort of mention it before, and I said I'll come back to it properly here, market liquidity. So the ability of the market to either absorb bonds that you want to sell or give you access to bonds which you want to buy in the right quantities, it also declines very much in times of financial stress. So a market that's absolutely liquid and full of transactions when conditions are good may turn to a market which is very sort of frozen up in times of financial stress, which is when you'll see bid-ask spreads widen to what may become a prohibitively expensive level. Okay, and right, having discussed these market factors, let's now move on to the third one. So if I go back to my list, which we had at the top, we said we would talk about macroeconomic, market, as well as issuer-specific factors. It's time for the issuer-specific ones. This is very brief because, to be honest, there is more of that discussion when it comes to specific videos and specific content on sovereign issuers and then corporate issuers as well. So issuer-specific factors, the third one. This is basically all about assessing the performance of the individual issuer and understanding that the yield spread is a function of that, the performance of the individual issuer. And what we would be looking for here is typically two metrics. That in a way show us how well positioned an issuer is to be able to make payments, and therefore how much risk we as investors take on. One is debt coverage, and you've heard me mention this in many different instances. Debt coverage simply measures the sufficiency of resources, whether sufficiency of the issuer's resources to make interest and principal payments. What is that relationship? How much do those resources cover the payments that need to be made? And those resources may be measured using cash flow measures, revenue measures, etc. There are different variants of measuring coverage. Now the other key metric is leverage. Leverage is all about measuring the relative reliance on debt, measures the relative, so not the absolute how much debt do you have, but how much are you relying on debt as part of your overall mix. So reliance on debt versus other forms of funding sources, especially equity, right? Okay, and let's just mention that analysts, what analysts often do is take the yield on bonds issued by a specific issuer and compare those yields to those found on corporate bonds coming from other issuers with similar ratings, perhaps belonging to the same industry sector, etc. And by making these comparisons, they try to spot the differences that should result from issuer-specific factors, because essentially, if you've got two bond issuers who have issued bonds with similar maturities, similar structures, and they operate in the same industry, they've got similar business models, but the yield on one is different to the yield on the other issuer's bonds, then perhaps that difference is down to issuer-specific factors. Otherwise, it's quite difficult to isolate these things unless you can you're able to make comparisons. And finally, I want to talk about one more idea which is in this section of the curriculum. I don't really know why. I know why, but I don't really think it's the right place for there to be. It's the right place for it to be in. In the final section of this learning module, your curriculum talks about spread risk. And this is the idea that if spreads change, especially unfavorably, so if they widen, remember we're talking about the spread over the government bond, the government yield benchmark. So a widening spread means that all the discounting that you do to bond cash flows to arrive at the price have a lower present value. It's all about the effect on bond price resulting from a change in the yield spread. And of course, if yield spread, of course, if the yield spread increases, if it widens, you're going to have a drop in the price. The question is how much? Well, there's a formula for this, but it's a formula that's introduced before in a previous, let's say, chapter, learning module, which I haven't covered in the videos yet, but I will cover. It depends on when you watch this video. I'm going to cover it in a matter of 1 or 2 weeks, so you'll be able to see it if you watch it a little bit later on. But the formula, it derives from the idea of modified duration and the convexity adjustment. And what you can do is you can quite reliably predict the percentage change in mathematics or physics, especially is denoted by delta, in the present value of cash flows. And basically this is the value of a bond, its so-called full price, which also includes accrued interest. If you haven't studied this, don't worry. If you have done it, you'll appreciate what we mean here. And the formula goes, it's the negative of annualized modified duration times the change in yield. So, you can imagine the yield going up or down by 25 basis points. That's 25/100%. That's one component. And there is also a convexity adjustment, which is always a positive one due to the convex shape of the yield curve, or sorry, the bond yield versus price relationship, plus half of the annualized convexity adjustment. Don't worry, if you haven't covered this, you'll cover it quite soon, times the delta, the change in yield. But this one has to be squared. Lots of people forget to do it in the exam if they get a question like this and they get the wrong answer. Now, the overall formula, or the generic formula, uses the change in yield. However, the yield on a corporate bond is basically made up of different factors. Where did we have this? We had it over here. Did we? Factors impacting yield spreads. Right, sorry, market factors, real interest rates, inflation premium, and then the yield spread as well. All of this goes to give us the yield on corporate bonds. All of these things, yield on corporate bonds combined. So the yield spread is just one component of the overall yield which investors expect from bonds, any bonds including corporate bonds. So the point is, you can easily substitute this change in yield and say, well, change in spread. If it's expressed in basis points, it will be treated just like any change in yield because it's a change to one of the components of the yield. Now, for some reason, the authors of the curriculum decided to show computations here, which are pretty much based on computations that you will be doing elsewhere in the curriculum, so I don't see any reason to do this here. And anyway, the learning outcome statement for this module says, describe the effect. Don't calculate it, and even though there are some questions at the end of the chapter which get you to calculate something, I don't think you should expect them in the exam. Or if indeed you will, you'll be able to utilize a formula that you'll know from a different section of the curriculum where you indeed have to do the computations. So it would be a very very much a waste of time and a good example of duplication if we started doing this here as well.